Welcome to Stock Market Today, your market briefing with actionable insights on stocks, bonds, crypto, and the events moving markets. Let's get into it. The Federal Reserve has executed a hawkish pivot that's reshaping cross-asset positioning as of March 2026. If you're trading equities, bonds, or crypto, understanding this policy shift is non-negotiable for navigating current volatility. The FOMC minutes from the January 27 to 28 meeting, released February 18th, revealed what analysts are calling a hawkish pause, and markets are still repricing the implications. Here's the critical context. After 3 consecutive rate cuts in late 2025, the Fed held rates steady at 3.5 to 3.75% at that January meeting. According to the official FOMC minutes, committee members are highly alert to sticky price pressures across multiple economic sectors. This isn't dovish language. This is the Fed signaling they are prepared to hold rates here or potentially hike if inflation doesn't demonstrate a sustained downtrend toward the 2% target. The dissents matter here. Fed Governors Waller and Moran both advocated for an additional rate cut, but the majority sentiment shut that down. Chair Powell is reportedly preparing to reinforce this hawkish messaging in upcoming communications, which means the market is pricing in higher for longer as the baseline scenario. Let's talk equities first. The major indices have shown surprising resilience despite the underlying hawkish tone. Recent sessions saw the Dow up 0.24%, the S&P 500 up 0.59%, and Nasdaq leading with a 1% gain. But don't let those green candles fool you. Beneath the surface, there's growing concern about earnings multiples compression, particularly hitting mega-cap tech and rate-sensitive growth names. According to Thrivent Funds Market Update from March 2026, stocks are wobbling as this rate reality sets in. The market is executing a sector rotation in real time. Technology and growth stocks face the most pressure because higher discount rates compress future earnings valuations. When the 10-year yield sits at 3.96%, suddenly that high multiple software stock trading at 40 times earnings doesn't look as attractive. Meanwhile, financial services companies are positioned to benefit from sustained higher rates. Banks make money on net interest margins, and a steeper yield curve with elevated short-term rates supports profitability. We're seeing institutional money rotate toward financials, dividend-paying equities, and value names that can sustain earnings in a higher rate environment. The bond market tells a more complex story. The 10-year Treasury yield currently trades around 3.96%, down 0.21% from late January levels. That decline might seem counterintuitive given the hawkish Fed stance, but it reflects market expectations for eventual rate cuts later in 2026. According to data from Y-Charts and the Federal Reserve economic data, the yield curve is recalibrating as investors position for a prolonged holding pattern before any accommodation. Credit markets are showing stress signals. Investment-grade spreads are widening, and institutional investors are shifting towards shorter and intermediate duration maturities. The market is pricing in the possibility of 2 additional 25 basis point cuts in 2026, totaling 0.5% in accommodation. But those forecasts are highly contingent on economic data, particularly upcoming inflation readings and employment reports. As reported by Investing.com, Bitcoin slid following the hawkish Fed minutes, reinforcing the higher for longer narrative. Cryptocurrency has emerged as one of the most sensitive asset classes to this policy shift. Bitcoin is currently trading near $70,500, but the volatility is intense. Intra-week fluctuations have ranged from approximately $63,000 to $73,470. According to Fortune's Bitcoin price tracking, we saw significant swings throughout early March. The crypto market correlation with traditional risk assets has increased dramatically during periods of monetary policy uncertainty. When the Fed signals hawkish intent, risk-off sentiment hits crypto hard. When there's any hint of dovish pivot, digital assets rally. Capital Street FX crypto analysis from March 4th and 6th noted that Bitcoin rebounded as geopolitical shocks faded, but the Fed policy backdrop remains the dominant macro driver. Ethereum is eyeing the $2,000 pivot level, and the entire altcoin market is taking directional cues from Bitcoin's reaction to rate signals. Crypto.com's analysis on how Fed rate changes affect crypto prices emphasizes the liquidity dynamic. Higher rates mean tighter financial conditions, reduced liquidity in the system, and less speculative capital flowing into risk assets like cryptocurrency. Lower rates do the opposite, flooding the market with cheap money that chases yield in alternative assets. Let's break down 3 strategic scenarios that market participants are gaming out right now. Scenario 1 is continued hawkish tightening. If inflation remains sticky and the Fed implements additional rate hikes, expect USD strengthening against major currencies, crypto and growth equity retreat, and defensive sector outperformance. Think utilities, consumer staples, and healthcare leading while tech bleeds. Scenario 2 is a neutral hold pattern. The Fed maintains current rate levels through the remainder of 2026. This results in asset consolidation across the risk spectrum, sector-specific performance divergence, and elevated volatility as markets trade on individual data points rather than a clear policy trajectory. Scenario 3 is a dovish reversal. Unexpected economic weakness forces the Fed's hand, prompting rate cuts sooner and more aggressively than currently priced. This triggers a liquidity-driven rally in risk assets, cryptocurrency market revival, and technology and growth stock outperformance as lower discount rates make future earnings more valuable. According to Bankrate's analysis on Federal Reserve impact on stocks, crypto, and other investments, the current environment demands dynamic risk management. Traditional asset correlations are shifting. The increased correlation between crypto and equities presents new challenges for portfolio diversification strategies that previously relied on crypto as a non-correlated asset. Here's what institutional positioning looks like right now based on market data. Reduced exposure to duration risk in fixed income portfolios. Nobody wants to hold long-dated bonds if rates are going higher or staying elevated. Increased focus on dividend-paying equities that provide income regardless of multiple expansion. Heightened attention to earnings quality over growth multiples. The market is rewarding profitability and cash flow, not revenue growth stories. And strategic cryptocurrency allocation adjustments, with many funds reducing crypto exposure or hedging positions. The iShares Fed Outlook 2026 report and rate forecasts and fixed income strategies emphasizes that this is a fundamentally different market environment than 2024. The Fed is prioritizing price stability over growth accommodation. That's a critical distinction. In previous cycles, the Fed often pivoted dovish at the first sign of economic weakness. This cycle, they're willing to accept slower growth to ensure inflation doesn't reaccelerate. The coming weeks are critical for market direction. Key economic data releases include the Consumer Price Index, Producer Price Index, and employment reports. Any surprises in these data points will either reinforce or challenge the Fed's hawkish stance. Fed communications from Chair Powell and other voting members will be parsed for any shift in tone. Yahoo Finance reported that Bitcoin falls and the dollar rallied on hawkish Fed minutes, demonstrating the immediate cross-asset impact of policy signals. That pattern is likely to repeat with each subsequent FOMC communication or significant economic data release. For traders, the playbook here is clear. Monitor Fed communications and inflation data religiously. Position for sector rotation away from growth toward value and financials. Manage duration risk in fixed income portfolios. Treat crypto as a high beta risk asset correlated with equity volatility, and maintain flexibility to pivot as scenarios evolve. The takeaway is simple. The Fed has shifted from dovish accommodation to hawkish vigilance. Markets are repricing across equities, bonds, and crypto based on higher for longer rate expectations. Cross-asset volatility is elevated and likely to persist as policy uncertainty continues. Your portfolio strategy must account for changing correlation patterns and risk factors that didn't exist in previous cycles. This isn't a time for complacency. The monetary policy landscape has fundamentally shifted, and understanding these dynamics separates profitable positioning from getting caught flat-footed when the next volatility spike hits. That wraps your market intel. Trade smart out there. For deeper insights and real-time analysis, visit capitalcopilot.io.